What's up everybody, it's A here, and welcome back to the channel. Today we're diving into a topic every small business owner needs to master: taxes. We're breaking down the top 3 tax mistakes that could cost you thousands in 2025, and how to avoid them. Too many entrepreneurs get hit with massive, unexpected tax bills that could have been prevented with a little know-how. By the end of this video, you'll have a clear roadmap to navigate tax season, keep more of your money, and stay out of trouble with the IRS. Let's get into it. So, you're diving into the world of business, ready to make your mark. But are you making a critical mistake that could cost you dearly? The first mistake: messy, incomplete records. A chaotic jumble of receipts, invoices, and scribbled notes. It might seem harmless now, but this disorganization can snowball into a major headache when tax season rolls around. Think of your records as the backbone of your business finances. They tell the story of where your money comes from and where it goes. Without a clear and accurate record, you're essentially flying blind. If you can't prove an expense, the IRS acts like it never happened. It's as simple and as brutal as that. No proof, no deduction. The IRS operates on the principle of substance over form, meaning they want to see concrete evidence to support your claims. A missing receipt is more than just a piece of paper. It's a missing piece of your financial puzzle. That means you pay tax on money you didn't actually keep. You're essentially paying taxes on phantom income, money that's already left your business. It's like being forced to pay for something you never received. This can significantly impact your profitability and leave you with less capital to reinvest in your business. Every dollar you can deduct lowers your taxable income. Deductions are your legal right as a business owner, a way to reduce your tax burden and keep more of what you earn. Think of deductions as discounts on your taxes. They directly reduce the amount of income that's subject to taxation, leading to significant savings over time. So missing receipts is like burning cash. You're literally throwing money away by failing to claim legitimate business expenses. Imagine taking a stack of $100 bills and setting them on fire. That's essentially what you're doing when you neglect your record keeping and miss out on valuable deductions. Poor record keeping is a red flag for audits. It signals to the IRS that your business may not be operating with the necessary diligence and accuracy. An audit is something every business owner wants to avoid. It's a time-consuming, stressful, and potentially expensive process that can disrupt your operations and damage your reputation. If your numbers look off, you're inviting the IRS to dig deeper. Discrepancies and inconsistencies in your financial records are like breadcrumbs leading the IRS straight to your door. Even unintentional errors can raise suspicion and trigger a more thorough examination of your finances. The more organized and accurate your records, the less likely you are to attract unwanted attention. The fix: set up a system. Implement a clear, consistent, and reliable method for tracking your income and expenses. This doesn't have to be complicated or overwhelming. Start with the basics and gradually refine your system as your business grows. The key is to establish a routine and stick to it. Use accounting software like QuickBooks or Wave. These tools are designed to simplify bookkeeping and provide you with real-time insights into your financial performance. Accounting software can automate many of the tedious tasks associated with bookkeeping, such as categorizing transactions, generating reports, and tracking invoices. This frees up your time to focus on other aspects of your business. Log every income and expense with details. Don't just record the amount. Capture all relevant information about each transaction. The more detail you include, the easier it will be to understand your financial records and justify your deductions if necessary. Think of it as building a strong case for your business finances. Date, amount, vendor, and purpose. These 4 elements are essential for creating a complete and accurate record of each transaction. The date helps you track the timing of your expenses, the amount is the monetary value, the vendor identifies who you paid, and the purpose explains why you made the purchase. Keep business and personal finances separate. Commingling funds is a recipe for disaster, making it difficult to track your business's financial performance and potentially jeopardizing your legal protection. Maintaining separate accounts helps you establish clear boundaries between your personal and business assets, which is crucial for both tax purposes and legal liability. Open a dedicated business bank account and credit card. This will streamline your bookkeeping and provide a clear audit trail of your business transactions. A business bank account allows you to easily track your income and expenses, while a business credit card can help you build credit and access financing opportunities. Save digital copies of every receipt. Paper receipts fade, get lost, and are easily damaged. Digital copies are a reliable backup. With the technology available today, there's no excuse for losing receipts. A simple photo can save you from a lot of headaches down the road. Snap photos and store them in the cloud, organized by month. Cloud storage provides a secure and accessible repository for your receipts, ensuring they're always available when you need them. Services like Google Drive, Dropbox, and iCloud offer ample storage space and allow you to easily organize your files into folders. Track all income and every possible expense. Don't overlook any potential deductions, no matter how small they may seem. Small expenses can add up over time, and every deduction counts towards reducing your taxable income. Keep a detailed record of everything, and consult with a tax professional to ensure you're claiming all eligible deductions. Advertising, software, travel, professional development, even your home office if you qualify. For home office deductions, know your square footage and related expenses. The IRS has specific rules for claiming this deduction, so it's important to be accurate and thorough. You'll need to calculate the percentage of your home that's used exclusively for business purposes and allocate expenses accordingly. Guessing isn't allowed. The IRS requires precise measurements and documentation to support your home office deduction. Don't estimate or round up your square footage. Use a measuring tape to get accurate dimensions and keep records of your calculations. Bought equipment? Save the purchase date and receipt for depreciation. Depreciation allows you to deduct the cost of assets over their useful life. This can result in significant tax savings over time, but it's essential to have accurate records of the purchase date and cost of the asset. Make bookkeeping a weekly habit. Don't wait until the last minute to scramble and try to piece together your financial records. Regular bookkeeping ensures that your records are up to date and accurate, making tax preparation much easier and less stressful. 15 minutes a week now saves hours and stress at tax time. A little bit of effort on a consistent basis can prevent a major headache later on. Think of it as preventative maintenance for your business finances. By staying organized and up to date, you can avoid costly mistakes and ensure a smooth tax filing process. Clean records mean you can file taxes confidently. You'll have peace of mind knowing that you're accurately reporting your income and expenses. With organized records, you can approach tax season with a sense of control and preparedness, rather than anxiety and dread. Or hand your accountant a tidy report, saving you money on their fees. The less time your accountant spends organizing your records, the less you'll pay for their services. A well-organized report allows your accountant to quickly and efficiently prepare your taxes, saving you both time and money. Remember, the burden of proof is on you. It's your responsibility to substantiate your deductions and prove the legitimacy of your business expenses. The IRS doesn't have to prove that your deductions are invalid, you have to prove that they are valid. This is why accurate and complete record keeping is so crucial. If you can't back up a deduction, you lose it. No exceptions. Even if you genuinely incurred the expense, without proper documentation, you won't be able to claim the deduction. Get organized now, don't procrastinate or put it off until later. The sooner you establish a system for record keeping, the easier it will be to maintain, and the less likely you are to fall behind. Don't wait for tax season panic. Avoid the stress and anxiety of scrambling to gather your records at the last minute. Tax season is stressful enough without having to deal with disorganized records. By getting organized now, you can alleviate a significant amount of stress and ensure a smoother tax filing process. Solid records are the foundation. They are the bedrock upon which you build a financially sound and sustainable business. Without a strong foundation of accurate and complete records, your business is vulnerable to financial instability and potential legal issues. Of a profitable, audit-proof business, invest in your record keeping, and you'll be investing in the long-term success and security of your business. So, take control of your records, implement a system, and build a solid foundation for a thriving and audit-proof business. Mistake number 2, and this one can really sting: missing or underpaying your quarterly estimated taxes. This is a common pitfall for many new business owners. When you're self-employed, you're essentially both the employer and the employee. That means you're responsible for sending the IRS their cut throughout the year, just like a regular employer would withhold taxes from your paycheck. No employer does it for you. It's all on you to manage those tax obligations. The U.S. uses a pay-as-you-go system. The government wants its tax revenue steadily throughout the year, not just in one lump sum at tax time. Skip your quarterly payments or underestimate what you owe, and you'll get hit with penalties and interest. These can add up quickly and put a real dent in your finances. The deadlines, these are crucial dates to remember. April 15th, marking the first major deadline of the year. June 15th, the second quarterly payment date. September 15th, the third important date to keep in mind. and January 15th of the following year. Mark them on your calendar, set reminders on your phone, do whatever it takes to keep these dates top of mind. How much to pay? This is the million-dollar question. Set aside 25-35% of your net self-employment income for taxes. This is a general guideline, and the exact percentage may vary depending on your specific circumstances. Federal, covering your federal income taxes. State, accounting for your state income taxes if applicable. And self-employment taxes, which include Social Security and Medicare. Every time you get paid, move that percentage into a separate tax savings account. Treat it like a sacred fund, specifically earmarked for taxes. Don't touch it. Resist the temptation to dip into that money for other expenses. When the deadline comes, the money's ready, waiting to be sent to the IRS. No scrambling, no debt. You'll be able to pay your taxes on time and avoid those nasty penalties. For more accuracy, use IRS Form 1040-ES. This form helps you estimate your self-employment tax liability, or consult your accountant, especially if your income fluctuates significantly throughout the year. A tax professional can provide personalized guidance and help you navigate complex tax rules. The Safe Harbor Rule. This is a helpful provision that can protect you from penalties. Pay at least 90% of this year's tax liability, or 100% of last year's tax liability, whichever is smaller. 110% if you made over $150K to avoid penalties. This higher threshold applies to higher income taxpayers, to avoid penalties. Meeting these safe harbor requirements can give you peace of mind. Don't forget state taxes. State income taxes are a separate obligation from federal taxes. Most states have their own quarterly system. Be sure to check your state's specific rules and deadlines. If you're new and unsure what you'll earn, overestimate. It's always better to err on the side of caution. Overpaying means a refund, underpaying means penalties. A refund is always a welcome surprise, while penalties are a painful reminder of what could have been avoided. Automate your tax savings and set reminders for deadlines. Technology can be your best friend when it comes to managing your taxes. Treat taxes like any other recurring bill, such as rent or utilities. Non-negotiable. Taxes are a fundamental obligation that must be prioritized. Ignoring quarterly payments is like ignoring a leak in your boat. The longer you ignore it, the worse it will get. It'll sink you if you don't fix it. Tax problems can quickly escalate and jeopardize your entire business. Be proactive, take control of your tax obligations, and you'll turn tax season from a crisis into a routine task. With proper planning, taxes don't have to be a source of stress and anxiety. Free up your mental energy for what matters, growing your business. Focus on your core competencies and let your business thrive. Don't let the IRS catch you off guard. Stay informed, stay organized, and stay ahead of the game. So, what's the third critical mistake that can sink your small business? Ignoring tax law changes. This is a big one, and it's surprisingly common. Many business owners get comfortable with a certain way of doing things, especially when it comes to taxes. They find a system that works and they stick with it. But the tax landscape is constantly shifting. What was true last year might be completely outdated this year. The tax code evolves constantly. It's a living, breathing document that's subject to legislative changes, court decisions, and IRS interpretations. These changes can have a significant impact on your tax liability, either positively or negatively, and what worked last year might cost you this year. Relying on outdated information can lead to missed deductions, underpaid taxes, and even penalties from the IRS. It's like driving a car using an old map. You might eventually get to your destination, but you'll probably take a lot of wrong turns and waste a lot of time and fuel along the way. New deductions, credits, and rules appear all the time. The government introduces new incentives to encourage certain business activities, such as investing in renewable energy, hiring veterans, or conducting research and development. If you're not aware of these changes, you could be missing out on valuable opportunities to reduce your tax burden. If you're not paying attention, you're leaving money on the table. Think of it as free money that the government is offering you, but you have to claim it, or risking penalties. On the flip side, failing to comply with new regulations can result in costly penalties and interest charges. The IRS is not known for its leniency, so it's crucial to stay on top of your tax obligations. You don't need to be a tax lawyer, but you do need to stay informed. You don't have to memorize every single provision of the tax code, but you should have a general understanding of the key changes that affect your industry and your business. The best move: work with a qualified tax professional. This is especially important for small business owners who often wear many hats and don't have the time or expertise to navigate the complexities of the tax code on their own. a CPA or enrolled agent who specializes in small business. Look for someone who has experience working with businesses in your industry and who understands the unique challenges you face. Meet with them at least once a year for tax planning, not just filing. Tax planning is a proactive process that involves analyzing your current financial situation and developing strategies to minimize your tax liability in the future. A good pro will spot new opportunities, warn you about expiring deductions, and help you make smart year-end moves, like prepaying expenses or maximizing retirement contributions. These strategies can help you reduce your taxable income and lower your overall tax bill. They'll know industry-specific breaks you might miss on your own. Certain industries have unique tax rules and incentives that are not widely known. A tax professional who specializes in your industry will be familiar with these breaks and can help you take advantage of them. Find a pro through referrals and ask them what tax law changes matter most for your business this year. This will give you a good sense of their expertise and their ability to stay on top of the latest developments. Do your own homework too. While a tax professional can provide valuable guidance, it's ultimately your responsibility to understand your tax obligations. Follow reputable financial news, subscribe to tax newsletters, and check the IRS website for updates. The IRS website is a valuable resource for tax information, but it can be overwhelming to navigate. Focus on the sections that are relevant to your business. Don't fall into the "this is how we've always done it" trap. Just because a particular tax strategy worked in the past doesn't mean it will continue to work in the future. Your business and the law both change. Your strategy should too. Regularly review your tax strategy with your tax professional to ensure that it's still aligned with your business goals and the current tax laws. The cost of ignorance, missed deductions, lost credits, and possible penalties. These are all consequences of failing to stay informed about tax law changes. Schedule a tax review now, not when you're already in trouble. Don't wait until the last minute to address your tax situation. Proactive tax planning can help you avoid costly mistakes and take advantage of opportunities to save money. A few $100s for expert advice can save you thousands. The cost of hiring a qualified tax professional is often far less than the cost of making a mistake on your taxes. Stay proactive, and you'll turn tax law from a threat into an opportunity. By staying informed and working with a qualified tax professional, you can navigate the complexities of the tax code and use it to your advantage. Make the rules work for you, not against you. Taxes are a fact of life, but they don't have to be a burden. With the right knowledge and guidance, you can minimize your tax liability and maximize your business's profitability. There you have it, the top 3 tax mistakes that can cripple a small business: messy records, missed quarterly payments, and ignoring tax law changes. You don't need to be a tax expert, just an informed, proactive business owner. This video is a starting point, not a substitute for professional advice. Consult a qualified tax pro who can tailor a strategy to your business and help you pay the least tax legally possible. If you found this helpful, hit like, subscribe, and drop your questions or tips in the comments. Thanks for watching, and here's to your financial success. See you in the next